The International Energy Agency, or the IEA, estimates that since 2010, the number of internet users worldwide has more than doubled, while global internet traffic has expanded 25-fold. The International Data Corporation, or the IDC, calculated that the amount of data created over the last 3 years was more than that created over the prior 30. The rollout of 5G connectivity globally, continued growth in connected devices, and the proliferation of the use of artificial intelligence suggests this trajectory in data traffic is set to persist. These trends provide a highly supportive backdrop for digital communication networks, which are becoming ever more critical to the functioning of economies. Infrastructure such as telecommunication towers, fibre-optic cabling, and data centres are often termed the plumbing of the internet and enable the data-driven economic revolution to function. And in today's episode, we discuss this opportunity directly with Benn Mikula, CEO of Cordiant Capital. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In today's episode, we are joined by Benn Mikula, CEO of Cordiant Capital, the investment manager of the London-listed Cordiant Digital Infrastructure, ticker CORD, or CORD. Ben has over 30 years of experience in digital and related areas, both within the financial industry as a top-rated equity analyst covering the tech and telecom sector at RBC, as well as holding a managing director position within the investment banking division of JP Morgan. He's also had experience within industry, having founded a wireless communications company in Canada. Ben has served on the boards of large public and private companies during his career, and is currently a member of the boards of both CRA and Hudson Interexchange, portfolio companies of Cordiant, which we reference in this discussion. Ben is supported by a sector specialist team at Cordiant, which includes the chairman of digital infrastructure, Stephen Marshall, who prior to joining the investment manager was president of the US Towers division of American Tower Corporation and was influential in building that US-listed business up to a $100 billion market cap company. Cordiant Digital Infrastructure IPO'd on the London market in 2021 and invested the initial and follow-on capital raises in a portfolio of private digital infrastructure platform businesses. Cordiant published annual results earlier this month, covering the financial year to the end of March. This report evidenced robust underlying operating performance from the portfolio, driven by both new contracts being won and the effect of inflation-linked revenues starting to feed through. However, the CORD share price, in contrast, has suffered markedly, in part reflecting the headwinds faced by the London-listed investment company sector, where average discounts have widened to historically low levels. The company has been carefully managing capital allocation decisions against this challenging backdrop and balancing the payment of a progressive dividend policy, which was increased by 5% in the last financial year, the initiation of a share buyback policy in Q4 last year, alongside accretive growth capital expenditure and bolt-on acquisitions, which are so critical to the long-term execution of the strategy. We believe the infrastructure sector has felt the impact of the headwinds facing investment companies on the London market particularly acutely. We believe valuations and implied returns from many constituents in this sector, which offer exposure to critical infrastructure backed by long-term contractual income, often with a high degree of inflation linkage, are attractive relative to comparable index-linked yielding securities within the market. This will be a topic we discuss with several portfolio managers operating within or investing in this particular area in episodes over the next few weeks. But please do get in touch with us if you'd like to see some of the more in-depth work we've done on this sector and for further details. Ben, hello. Good afternoon. How are you doing today?
Gordon, I'm well. Good afternoon to you. Thank you very much for having me on that. What do I call it? Your show.
Yeah.
I'm honored and delighted to be here.
Hello, no, glad to have you on. So our kind of standard opening question is one that tries to get a bit to know you really, and your kind of maybe your typical working week or something that you've been working on recently. So we've been asking our guests if they can share perhaps an anecdote from a recent meeting or an article or book that they've recently read. Is there anything that you can share with?
Well, a typical working week or an anecdote. I'm CEO of the firm as well as co-head of the digital franchise. We also have a variety of private listed funds in the agriculture and the energy transition space as well as digital. So to the delight of British Airways, I spend an inordinate amount of time on airplanes. The past couple of weeks I've been across the Atlantic twice. I've been to the Gulf, and I've been to Prague for a board meeting for one of our digital portfolio companies. And what I can say that is quite fascinating, and I commend everybody to this, is the state of development, the pace of development in the Emirates is absolutely staggering. I recently had a bit of time after one meeting and went on to Al Saadiyat Island, where I visited the Abrahamic complex, which is a mosque and a synagogue and a church, a Catholic church, that have been put up at vast expense facing each other on this sort of pediment. And there are three relatively identical buildings with the detailing evidencing the relative faith markers, as it were. I don't know what they've spent on it. It wouldn't have surprised me if they'd spent $1 billion, but it's an absolutely remarkable testament to the pace and quantum of development there. And it sits looking across at a natural history museum and outposts of the Louvre and the Guggenheim. Just extraordinary. I don't think we're used to seeing this kind of development at speed in sleepy old Canada, UK, or Europe.
Yeah, no, in London. Yeah, no, fascinating. Yeah, and thank you for that. So, Ben, I wondered if we could kind of start off by perhaps kind of setting the scene of kind of what we actually mean by digital infrastructure. I mean, it's very obvious to everyone, all the listeners, that we're creating, using, manipulating more data than we ever have. More connected devices. The kind of data traffic is kind of exponentially growing. That seems very obvious, but I wondered if we could to kind of set the scene, just kind of summarize what we actually mean by the kind of infrastructure behind that, and perhaps if I could ask you to kind of summarize, if I can, the kind of main features of that kind of top-down investment case for these infrastructure assets.
Well, certainly, Gordon, and I think the critical things to be aware of are that this is all driven by our use of data in our personal and business lives, as you began by noting. And we're now into the third or fourth year of over 20% growth in data volumes. And a zettabyte is an astonishing amount of information, and we're probably looking ahead to having 150 of them this year. It's a staggering amount. And that data is created and manipulated and used. And what's the transmission mechanism? You know, if water needs to flow around a city to businesses and homes, restaurants, it needs a network of pipes. Electricity needs a network of transmission lines and feeder lines to the individual homes or office buildings. The same thing applies in digital infrastructure. And so there really are three types of plumbing of the internet, as it were. There are the mobile networks, where radio equipment sits primarily on towers, and those towers are connected by fiber or more wireless equipment. That's the first type. The second are their data centers to store and process the data and act as digital crossroads as data goes from point A to point B. And then there's the fiber, which are the backbone roads, the major shipping lines of the internet, as it were. And hopefully my transportation analogy is not creaking and about to expire at this point. But that's really what we invest in, is those three elements: the towers and backbone of the mobile network, the data centers, and the backbone fiber networks that carry this astonishing amount of data from one data lake to another and from one user to another, and enable the myriad ways in which we interact with the digital world and the digital economy. So that's what it is. And fundamentally, it's pretty boring stuff, Cord, because the technology and the software is filled with change and excitement and technological disruption. But a mobile tower that was put up 25 years ago is still going strong. It's hosted GSM and 2G and 3G and 4G, and now it's hosting 5G. And there will be a 6G. And maybe it was connected by radio backhaul, and now it's connected by fiber, but it's still a tower. And we may end up putting a different kind of backup power. We may go to a hydrogen fuel cell, but a tower is a tower is a tower. And the data centers, are very much still much as they were when I, began in this industry. Before I became an investor, I ran JP Morgan's technology investment banking group. And, we still see data centers that were air-conditioned warehouses 25 and 20 and 15 years ago coming around. And I go, yeah, saw that one as a banker, seeing it as an investor. And there's still air-conditioned warehouses. But what goes on in them has changed fundamentally. With AI, the power density at the rack level has gone up, and you need much more powerful and indeed new types of climate control. But the core infrastructure that we invest in is still boringly the same. And same applies with the big backbone fiber routes. You need more of them, but it's still the same old thing. So that's, really what it is. And I'm sure we can talk about the, some of the investment characteristics of these, but that's what it is. It's the plumbing of the internet.
Yeah, thank you for that. That's really helpful in kind of laying the groundwork. And I did want to move on to the kind of characteristics from an investment point of view now, actually. So I wondered, I don't know how best to do this, but whether there are some examples of assets that we could kind of go through and talk about the kind of typical tenants that would use those, and the kind of types of payment contracts that underpin them, to kind of get a sense of kind of the investment principles of owning these assets.
So if we take digital infrastructure as having three principal blocks: the towers, the data centers, and the fiber backbone, let's talk about what's common to all three, and let's talk about what's different for each one of these subcategories. All of these assets are long-lived. The technology change goes on inside or on these assets or connected to these assets. The plumbing of the internet doesn't itself change all that much. The customers tend to be blue chip. Now, they change subtly between the different subcategories, but they all tend to be blue chip or government. The contracts tend to be long-term, or they tend to be annual renewal, but with people not moving because it's a pain. Everybody knows moving house is painful. But imagine if moving house then required you to do much, much more than change all your addresses and, get all your new utility providers. There's a huge change in moving from a data center, for example. So even when you're on annual renewal, you tend to be automatic renewal. It's really only M&A that gets people to change. Oftentimes you have annual price escalations, and the price escalations don't have to be fully for inflation. This can be a great business even if you have capped inflation adjustments and price adjustments, because these are high gross margin businesses. And so inflation's only touching maybe half of your cost base. Things like power tend to be passed through. So these are the characteristics of digital infrastructure. Now, in the tower business, your customers tend to be the mobile operators. And these are companies like Vodafone and O2 and these sorts of companies, Verizon and AT&T in the United States. And data centers, you get a much different grouping. Now, there are different kinds of data centers. The huge data centers that might have 100 megawatts of power consuming the same amount of power as a town. Those tend to be leased to the so-called hyperscalers or cloud scalers. And hyperscalers are firms such as Microsoft or Amazon Web Services or Google. Cloud scalers are companies such that are basically solely on the internet, the likes of Facebook, or Meta, as we're now supposed to call it, and other firms like that. Wholesale data centers are still very large, but they tend to serve the biggest corporations. A Rolls-Royce, for example, might be an example of a corporate customer, or government customers, or a large software as a service company such as an Oracle. So they have a different set of corporate customer, large hospitals, for example, universities, things like that. Then you get into edge data centers, and there are all manner of customers that need to be near a specific customer set will rent a smaller amount of space in a smaller facility that is located closer to customers. That's the broadest customer set, but they aren't buying huge amounts. And then interconnect data centers, and we have a particularly prominent one in our Cordiant Digital portfolio. There, anybody with a network or a need to connect to a network buys space, because these are digital crossroads. They're the Piccadilly Circus. Multiple roads coming in, multiple roads coming out, everybody showing up there, people coming from here, going there. If the Virgin broadband network needs to connect to Disney, it'll do so in one of these networks. Think of any possible combination of data and user, it probably goes through one of these. Indeed, this call is quite potentially going through our data center in 60 Hudson right now, not as a high processing use, but as a pure connectivity use. So that's the customer base there. And then on fiber, again, it's the big companies, it's the mobile companies, it's the government, it's all of the above, because the fiber is the most ubiquitous use for data centers. So those are the characteristics, and those are some of the customers. We like it because this is a very stable business. You can have 15-year contracts. You've got long visibility on the asset. They're high gross margin businesses. They're high EBITDA margin businesses. The inflation tends to be your friend over time, and it tends to work very well. And that's why we were able to, the fact that this is an exciting area has allowed us, I think, to buy good assets and perform well for investors.
Yeah. Yeah, and I think a point that you actually referenced slightly in an earlier question about the actual technology within the assets themselves. Another, perhaps not an investment characteristic per se, but it kind of feeds into that margin argument of the obsolescence risk of that kind of technology piece is borne largely by the customer, isn't it? In this case, it's not something that you're exposed to in any great way.
Yeah, I mean, I'll give you an example of if you take I'm sure many of your listeners are familiar with seeing the odd tower on the M4 as they drive out of town. I'll tell you, those towers, okay, many of them have been around for 20 or 30 years, and over that time, your clients may have used a Nokia phone, BlackBerry, and various models of iPhone to connect to equipment that is made from to connect to radio equipment that was provided by Alcatel, which is now Alcatel-Lucent, by Nortel, which no longer exists. So think of all of the technology I've just mentioned. Half of those companies don't even exist anymore or provide that product set anymore, and yet the tower is still there. So there's not been that obsolescence risk with the core physical layer of the internet. All the change happens in software and the user devices.
Yeah.
So we like those elements.
Yeah, good example. Yeah, thank you for that. So the Cordiant kind of approach isn't one that's kind of simple, kind of passive ownership. You're typically taking controlling stakes, if not if not acquiring the entire business of these underlying companies. And I hear you often talk about this buy, build, and grow strategy. You often kind of reference that in your reporting. I wondered if you could maybe provide an example of kind of that in action, if I could ask you to do that.
Certainly. So there are a couple of interesting opportunities in the market today. One is that middle-sized platforms, by which I mean something comfortably below $1 billion, but not tiny, not 50 or 100 million. Middle-sized platforms are priced much lower than large platforms, and that's a function of what's gone on in the large private equity and private infrastructure funds. In that area, a number of mega market participants like Brookfield have raised 20 billion funds, and they're out to buy things worth $1 billion, $2 billion, $3 billion, $5 billion. So if you can take something that you buy for 400 million and make it worth $1 billion, you'll get a valuation bump. So we like that. If you buy something worth 400 million and you make it worth $1 billion because you've grown it, on the way through, your margins will have gone up. So we like that element of it too. And as you grow that company, you can also bring on board best practice from large companies and make it even more profitable. So that's 3 ways to make money by buying these middle-sized platforms and growing them. That's buy, build, and grow. Now, how do you grow? You build new capacity, generally pre-leased to construction cost, or you buy other companies and fold them under your platform, and we're doing both. So let me give you an example, a live example from our portfolio. Now, we have a company in the Czech Republic called CRA. And the Czech Republic is actually a mini Germany. It has wonderful public finances. England, or the United Kingdom, I should say, would that it had the public finances of the Czech Republic and the GDP per capita growth rates of the Czech Republic. We have a formidable management team at CRA. We bought the business at about, a little over 10 times. And what have we done with it? Well, we've taken a platform that was mainly in broadcast and mobile towers. So we've grown the mobile tower business. We've started to monetize the national fiber network, and we basically created a data center business, which has gone from close to zero to almost a fifth of the business, from zero to a fifth of the business. And we've done that by building what is now 8 edge data centers, by buying a cloud services company, C4C, which we bought a few months ago and which is racing ahead of budget and the investment case, and by taking a piece of land that we owned, that had a substation on it and that was connected to the very epicenter of Prague by fiber we also owned. And we're building a 26 megawatt data center campus there. And it's an interesting story because that will, probably more than double the size of this business if we lease it out fully. There's huge growth around that. It would make us the most important player in the Czech market. And just to put some numbers around that, Microsoft bought a piece of land of about the same size and tried to develop it. And they paid 60 million euros. I think, don't quote me on that number. It's round numbers, tens of millions of euros for that land. And they weren't able to get the permits. We're basically almost through the permitting process on this land. So we'll have edge data centers, co-location data centers, cloud services, and a big wholesale data center campus. Basically, we had nothing just a few years ago. And there's huge value that's been created here. We're probably en route to having a business that can be spun out on its own. And that's a classic example of buy, build, and grow and what you can do with assets in this business.
Yeah, no, thank you for that.
Hopefully that brought it to life.
Yeah, it does. Yeah, a good kind of live example from within that portfolio at the moment. You mentioned as you were talking about kind of mid-market assets, the valuation multiple kind of relative to some of the larger transactions. I wonder if we can maybe touch on the current opportunity. I mean, obviously, since you IPO'd Cordiant, we have gone through a pretty significant change in the economic environment with interest rates and inflation. But I wondered if you can maybe run us through kind of current aggregate portfolio valuation against the context of kind of recent operational performance, just to give us a sense of how attractive the current opportunity is.
Well, we are growing as fast or faster than the large tower companies, for example. And yet our current imputed multiple for the portfolio is about 8 times, which is less than half of what you pay for a Cellnex, for example, to pick a European publicly quoted tower company. So we're less than half the valuation. We are about a third lower than they are in debt to EBITDA. We have comparable margins. And that, I think, is just a function of the tough fund flows conditions that we have in the trust market, where thanks to this ludicrous FCA fee counting issue and the competition from gilts, amongst other things, there's not been as much money flowing in. So we're essentially producing as good growth with less leverage at half the price. So I think that's the short form answer for how we compare to the rest of the telecoms infrastructure, digital infrastructure industry. Were we to be able to bring more growth capital on board in our chosen area of the mid-market, there's some very attractive opportunities for us to pursue. There's some attractive organic growth opportunities for us to pursue as well. All of those have very high IRR, sort of 15% or better opportunities. So we're very excited about the opportunity set in the industry and somewhat dismayed that we don't have more capital to go after them. And as from an operating point of view, I mean, as you've seen from our recent results, with high single-digit revenue and EBITDA growth rates for a diversified portfolio, we're quite happy with how these assets are performing.
Yeah, no, thank you for that. Yeah, unfortunately, a recurring theme on the investment trust discounts. Listeners that would have listened to previous episodes would have heard that, but particularly acute in the infrastructure space. But Ben, I wondered if I could move on to the issue of kind of environmental considerations. I mean, clearly, as you've mentioned in prior questions, there's a big power and water usage with many of these assets, such as a data center. I wondered if you could kind of touch on how you address that from the point of view of an owner of these assets.
Sure. The trying to be a responsible participant in this industry is the very core of our approach. People can throw a lot of ESG acronyms around and quote all of that, but I don't think that's particularly meaningful for your listeners, because probably they'd like the practical answer. And the practical answer is you've got to reduce the amount of water used. Above all, you've got to reduce the amount of electricity you use. And how do we do that? Well, we really have 3 pillars: make the individual assets as efficient as possible, move to purchasing renewable energy, and try and have renewable energy generation on site to increase that where possible. So we're pursuing all of the above. Every company has a plan to get to a higher mix of renewable energy. Now, I think we have to be honest as not just an industry, but as a society. What are the trade-offs? So, Slough is now rapidly becoming overrun by the mushroom-like growth of data centers. And there will be issues around grid connectivity, around power availability, about choosing how water is used if you want to keep building data centers. And, it's not as though this isn't something that we have a say in, because every time people photograph a plate of food in a restaurant, post it on their social media, and it goes up to a vast data center in Luleå, Sweden, never to be looked at again, but consuming electricity as it sits there ready for eventual view. That's an impact, and aggregated by tens of millions of citizens, that has an impact. That means you need to build more data centers. And we need to have an honest conversation about these trade-offs as a society, and I think it will come. Now, is that going to change the desirability of the digital infrastructure sector as an investment category? No, because we're going to build more data centers. The question is, are we going to double the number of data centers or triple the number of data centers? But these are the kinds of issues that we need to talk about when it comes to sustainability. How is data used? And can all the market participants be as efficient as possible? And if they're as efficient as possible, there will be some cost elements that ultimately show up in your mobile bill or your fiber bill or the bills of some of the services you use. And so I don't think we should shy away from these. But it's still a great growth industry. I mean, as I said, we're now into the fourth year of over 20% annual data growth. The numbers are just staggering.
Yeah, no, absolutely. And then our kind of standard final question asks the speaker to pick a kind of one area that they're particularly high conviction in or particularly positive in. Like, I'm always conscious with an investor such as you, when you've got such a close portfolio, I don't need to kind of choose your favorite baby within the portfolio. But I wondered if there was one particular area of the grid or the network that you think has particularly high growth trajectory at the moment, or whether there's a company that has a kind of near-term catalyst that you would point to, that you could kind of answer that question with.
Well, certainly we have some very balanced and steady growth in the towers and backbone fiber space, and we're excited about those. And there certainly is more that can be done, I think, in particular in the backbone fiber. But data centers is probably the area where you're seeing growth. And I've already referenced the CRA example. We're certainly looking to maximize both an inter-exchange and CRA and see what we can do, if not with our own equity, but with partner equity to expand and make these more interesting and make more money for our shareholders. So that's what we're very much trying to do. And we're hugely excited about that area. So, but I will say with some regret, if we had more money, there would be several opportunities I'd be pursuing, Gordon, not just one. There's a very attractive opportunity set out there in digital, and we hope that we can get back to the place where we're able to deploy a lot more capital, because it's a great sector to invest in.
Yeah, absolutely. No, that's been very, very clear. Ben, thank you so much for your time. We really appreciate you talking to us today.
Gordon, it's a favorite topic, so thanks for letting me come in.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.